Hello Keystone investors, welcome back to another video. In the world of financial planning, the concept of retirement has often been associated with visions of golden years spent in comfort, made possible through a mix of savings, pension, social security, and investment portfolios. For decades, traditional financial vehicles like stocks, bonds, and real estate have been the cornerstone of such planning. The principle has been simple, yet effective. Save and invest wisely during your working years, diversify your portfolio, and let the magic of compounding work its course to secure your future. But as we navigate through the digital age, the financial landscape is rapidly evolving. A new player has entered the ring and is changing the global economic environment. This player is none other than cryptocurrency. That's right, cryptocurrencies, the most famous of which is Bitcoin, which emerged in the wake of the 2008 financial crisis. Built on innovative blockchain technology, cryptocurrencies promised a new era of financial independence, transparency, and security, offering a decentralized digital alternative to traditional finance and fiat currencies. Fast forward to the present day, and cryptocurrencies have gone from being a fringe technology to a recognized asset class, with a total market capitalization running into trillions of dollars. Bitcoin, Ethereum, and thousands of altcoins have not only made headlines, but also have started to find their way into the portfolios of the average investor. As cryptocurrencies continue to reshape the financial ecosystem, one can't help but wonder, could these digital assets play a significant role in retirement planning? Could they potentially constitute a new asset class for long-term investment? In this video, we're not only going to be exploring these questions, but we'll also guide you through the practical steps to include cryptocurrencies in your retirement planning, with insights into the pros and cons, the risks involved, and the potential benefits. And to top it all off, we'll introduce you to the concept of crypto IRAs, a unique retirement investment option that you may have not encountered before. So whether you're a seasoned investor or just beginning to consider cryptocurrencies, stick with us to the end, as this video could fundamentally transform your approach to retirement planning. Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies issued by governments, also known as fiat currencies, crypto operates on a decentralized platform, and the prefix crypto refers to the complex cryptography that allows for the creation and processing of digital currencies. Now, cryptocurrencies are typically built on a technology called blockchain. A blockchain is a distributed ledger enforced by a network of computers, or nodes, each holding a copy of the entire system. These nodes work together to validate all transactions on the network, providing a high level of transparency and security. Now, each transaction made with a cryptocurrency is then bundled into a block and added to the chain of historical transactions. This chain creates a public ledger called blockchain, which acts as an indisputable record of all transactions for that specific cryptocurrency. Now, Bitcoin was the first cryptocurrency and remains the most well-known and valuable. This paved the way for thousands of different cryptocurrencies known as altcoins, each with its own unique features and use cases. So cryptocurrencies provide a decentralized financial system, putting you in control of your funds, without government intervention or potential manipulation. This transparency also helps minimize the potential chances for fraud and corruption. Now that we have a fundamental understanding of what cryptocurrencies are and the technology that powers them, let's dive into their role as an investment and how they could potentially fit into your retirement plan. Now, as we transition towards examining the role of cryptocurrencies in retirement planning, there are three primary factors that makes cryptocurrencies an intriguing prospect. Firstly, the potential for diversification. Diversification, as many seasoned investors know, is a fundamental strategy in finance, a means of spreading out investments to reduce risk. Traditional models suggest a mix of stocks, bonds, real estate, and possibly precious metals. Cryptocurrencies, however, provide an additional level of diversification. They've shown a low correlation to other asset classes, which can be helpful in spreading risk and potentially boosting returns in the long run. Next up, the potential for high returns. Cryptocurrencies are known for their wild price swings, but in some cases, this volatility has led to impressive gains for investors. Take Bitcoin for instance. Someone who invested a modest amount in the early days could now be sitting on a fortune. While past performance doesn't guarantee future results, the remarkable growth of many cryptocurrencies has caught the eye of investors who are seeking assets with the potential for high returns. Lastly, cryptocurrencies, especially Bitcoin, are seen as a possible hedge against inflation. As central banks globally print more money to address economic issues, some investors turn to assets with limited supplies to protect their wealth. With Bitcoin's maximum supply capped at 21 million coins, it's often compared to gold. As a result, it's viewed by some as digital gold, helping to guard against inflationary pressures that can diminish the buying power of traditional currencies. It's important to note, however, that while cryptocurrencies offer these potential benefits, they also come with their own set of risks and challenges. These must be carefully considered before integrating cryptocurrencies into your retirement plan. The first risk you often hear about with crypto is their well-known market volatility. Crypto prices can change drastically in a short period, leading to big gains or losses. When planning for retirement, this volatility could be risky, especially if the market drops close to your retirement date. So it's essential to know your risk tolerance and think about how much of your retirement savings you want to invest. Now let's talk about security and storage concerns. While blockchain technology is secure, individual cryptocurrencies can be stolen if not stored properly. Cryptocurrencies are typically stored in a digital wallet, which can be vulnerable to hacking if not well protected. Also, unlike regular bank or investment accounts, you usually can't recover cryptocurrencies if you lose access to your digital wallet. So it's essential to know how to safely store your cryptocurrencies. Now in the end, cryptocurrencies bring an exciting opportunity as a new asset class for retirement planning. However, it's crucial to be aware of and consider the risks and challenges that they pose. As with any investment, taking a thoughtful and well-researched approach is the best way to go when thinking about adding cryptocurrencies to your retirement portfolio. So you've weighed out the pros and the cons of including cryptocurrencies into your retirement plan and might be wondering how to get started. So here are some key steps to help you along the way. First, let's discuss investing in cryptocurrencies. Typically, people use cryptocurrency exchanges like Coinbase, Binance, or Kraken, where you can buy, sell, and hold digital assets. After setting up an account, you can purchase cryptocurrencies using traditional money. Now, once you've bought them, you'll store your cryptocurrencies in a digital wallet. This could be offered by the exchange, or you can use a separate wallet. And wallets can be online or offline, with offline wallets being more secure. Now, when it comes to wallets, make sure your wallet is safe and you have a way to recover your assets if you lose access or forgot your password. Now, think about which cryptocurrencies to invest in. Bitcoin and Ethereum are the most popular, but there are thousands of altcoins with their own potential benefits and risks. When choosing a cryptocurrency, consider its use case, the team behind it, market capitalization, liquidity, and price history. And remember, always do your own research instead of investing based on hype or speculation. Lastly, decide what portion of your retirement portfolio to allocate towards cryptocurrencies. Due to their volatility, it's probably not wise to invest a large percentage of your retirement savings in them. Many financial advisors recommend a modest allocation. However, this can vary greatly depending on your financial situation and risk tolerance. Incorporating cryptocurrencies into your retirement planning calls for a thoughtful approach. Always remember not to invest more than you can afford to lose, and consult a financial advisor if you're unsure. Cryptocurrencies bring potential benefits, but also have unique risks and challenges. By understanding these and taking a measured approach, you can navigate the crypto investing and potentially boost your retirement savings. Now, as we explore cryptocurrencies in retirement planning, the crypto IRA has been gaining attention. So what is crypto IRA and how does it fit into your retirement strategy? A crypto IRA or cryptocurrency individual retirement account is a type of self-directed IRA that lets you invest in cryptocurrencies within a retirement account, like traditional Roth IRAs. You can contribute and let your investment grow while having the flexibility to buy, sell, and trade cryptocurrencies. So why should you consider crypto IRAs for retirement planning? The main benefit is the flexibility it offers for your investment strategy. With cryptocurrencies' volatility and potential for high returns, being able to trade within a retirement account can be a considerable advantage. Crypto IRAs also allows for better diversification in your retirement portfolio, giving you another way to hedge against the market uncertainties. Crypto IRAs ultimately provide extra flexibility for those looking to include digital assets in their retirement portfolios. As with all investment decisions, evaluate your risk tolerance and personal circumstances before moving forward. Ultimately, deciding to include cryptocurrencies in your retirement plan is a personal choice. You may also want to consult a financial advisor to help guide your decisions. And that brings us to the end of today's video. Stay tuned to Keystone Investors for more finance and investment insights. Don't forget to like, share, and subscribe for more content, and I'll see you in the next video.